On August 5th, 2024, the VIX surged 180%, topping out above 65, roiling markets and sending investors scrambling. This has only happened 3 times since 1990. And in this video, we're going to analyze some of the reasons for the market crash, and we'll get into our best trade ideas for navigating this market turmoil later in the video, so definitely stick around. So what went wrong in the market? To understand why the VIX went absolutely insane on Monday, we need to go back to an event that happened the previous Wednesday. On July 31st, the Bank of Japan surprised global markets by raising its policy rate to 0.25%, which was only its second rate hike in 17 years. The BOJ also announced plans to slow bond purchases to reduce economic stimulus. This action, combined with rising unemployment in the US and what appears to be a high probability for multiple rate cuts by the Fed throughout 2024, all combined to cause the beginning of a sell-off in equity markets across the globe. A significant factor in this market downturn was the unwinding of the yen carry trade. What exactly is a carry trade? A carry trade is an investment strategy that involves borrowing currency from a region with low interest rates and investing it into a region with high interest rates. The Japanese yen has been a popular choice for carry traders due to Japan's historically low interest rates, and this carry trade has been going on for a long time. The success of the carry trade depends on several factors, however: the borrowed currency's interest rates remaining low, and market stability. Recent events in the US and Japan have disrupted both of these factors simultaneously. Japan's interest rate policy shift coincided with a rapid increase in the yen's value relative to the dollar. Economic concerns weighed on U.S. stocks on Friday as speculation about aggressive policy easing drove the dollar to its lowest value since March. Simultaneously, market volatility surged to its highest level of the year, continuing to rise on Monday to its highest point since the pandemic sell-off in March 2020. So amidst all of this market chaos, how are we trading this market event? One of our first trading strategies to play this event is a long-short play on SMH. SMH is the semiconductor ETF, and if we just look at the chart here, since the highs back in the middle of July, SMH and really the rest of the market in general has been selling off. Semiconductors obviously have been hit the hardest with the unwinding of the tech trade and some of the weaker than expected earnings reports. Just recently, we've actually initiated a short play right in here off of this bounce here off the lows. We think this is potentially a dead cat bounce, but ultimately what we want to do, in case that we're wrong, we want to put on a long and short play as well. So we're looking to add potentially a long play that could take advantage of any bounce back up into this 230 level, or even a continuation back into the 240 level, which is currently our zero gamma level. If you're not familiar with gamma exposure, it's a tool that we use quite extensively. I'll put a link to our GEX playlist in the description below if you want to learn more. So our thinking behind this long-short play is twofold. One, gamma exposure is very negative here, coming all the way back into this 210 to 200 level. If we just take a quick snapshot, gamma exposure is basically telling us where option dealers and market participants are the most active. And we can see the largest gamma exposure concentration is at this 210 strike. So it's about 5% lower than where SMH is trading right now. If this is in fact a dead cat bounce, SMH could quite easily sell off back into this 200 to 210 zone. This is our base case scenario. However, if the carry trade ends up unwinding faster than we think and is really, let's say, over today or tomorrow, the market could easily see a very quick shift. Short covering combined with new market participants coming in up here, let's say at the 250 strike, even at the 260 strike, we've been seeing, large volume. These blue bars are our option market volume today. We've been seeing quite high volume coming in at the 250 and 260 strike. The purple bars are our gamma exposure concentration levels on an absolute basis. And so as you can see, there is already volume coming in at the 250 and 260 strike. So this is kind of a interesting point in time here. Semiconductors are still in this downtrend. And so, we're kind of at this, coming to this very crucial zone, I would say, where a potential breakout is possible, but there's also a possibility of a rejection back to the low. And so we think the highest probability trade is a long short play to take advantage of whichever direction works out the most. And with volatility crashing back down very substantially since the peak on Monday, option premiums have also crashed quite a bit over the last several days, making it relatively cheap to enter a position like this. So as I mentioned, we already put on the bearish side of our long short play on SMH. We at least initiated that legging into the bearish side. We're going to be adding more to that as time progresses, as well as adding our bullish side of the long short play as well. So if you're interested in following along, I'll put a link to our trading community Discord in the description below. Definitely be sure to check that out. The next play we put on to take advantage of this market turmoil here, actually just in the last couple of days, is a long position on IWM. IWM being hit even harder than tech over just the last couple of days. We've seen some support here off of our dealer cluster zone. You can see we had a really nice bounce right off of this zone, which is just at the 200 level. That's the largest gamma exposure concentration. IWM is bouncing here. We think that this is a strong support level. So we've added an IWM position to our portfolio to take advantage of this pop. And what's crazy is that IWM sold off 15% in just those few short days, from basically the 230 level down to 200 within just a few trading sessions. So really significant move. If there is any kind of snapback rally, we think IWM has a lot of potential. And so we are monitoring very closely the positive gamma exposure concentrations between 210 and 220 specifically to see if this ramp will continue back up into this zone here. Our next trading strategy involves a series of different trades that are encompassed in this theme of rotation trades. The market has been in a significant rotation for about the past month. If you look here over the last month, performance by various sectors, we can actually sort this over the course of the past month by ascending values. Electronic technology and technology services have gone down the most, 11.28% and 9.06% respectively. If you look just down here further on at the end, you can see the best performing sectors have been health services, communications, utilities, all of the type of sectors you would expect to do well in a difficult market environment. So we're continuing to trade names like healthcare services, which is up over 10% in the last month. Financials, we're looking at a number of names there, up over 2.5% in the past month. Tech, for example, we are, as I mentioned earlier, we're long short the SMH, and so we're looking for opportunities to take advantage of movements in both directions because we think we are at a kind of a crucial inflection point in the market. And so we practice an asymmetric risk reward strategy, which you can learn more about. Go to our website, geeksoffinance.com. You can access our gamma exposure dashboard. We also have our Geek University 5-hour option strategy, gamma exposure, volatility, and our geek trading strategy, all included in memberships. Definitely check that out. We'd love to have you join us. Thanks so much, everybody, for watching, and we'll see you guys in the next video.